Welcome back to the Deep Dive. Today we're looking at a really interesting one, a standout in U.S. logistics, Old Dominion Freight Line, ticker's ODFL. Yeah, and as we dive into the sources, these are current as of September 20, 2025. The stock's sitting around $141.79. But here's the thing we really need to unpack for you. You've got this huge trucking company, right, in an industry that's famously up and down and needs tons of capital, yet somehow, even in a big freight downturn, they're maintaining these, well, frankly, staggering profit levels, industry-leading stuff. So the questions are, how are they doing it? And maybe more importantly for investors, what does that resilience tell us about the stock's actual value, especially when our own analysis suggests it might be worth more than where it's trading right now?
It really is a fascinating case study, almost textbook, you know? We're going beyond just trucks and trailers today to look at what creates a truly durable competitive advantage, what people call a moat. ODFL seems to have built this logistical machine that just delivers quality others can't easily copy. And that's what we want to map out. And just a quick note, this analysis is tailored for you, our subscribers. We know this was a highly requested ticker.
Okay, let's jump right in. How does this business actually work?
Right, Chapter 1, Business Analysis.
So ODFL's core is Less-Than-Truckload, LTL. Now, for anyone not deep in logistics, this isn't just filling one truck and sending it off. It's complicated fast.
Exactly. LTL means handling lots of smaller shipments from different customers, all needing to go in roughly the same direction. So you have the initial pickup, then quick sorting at a local service center. Then comes the really efficient part, consolidating those shipments onto long-haul trucks for the overnight line haul journey. Big distances covered there.
And then the reverse on the other end. Breakdown, sort again, and final local delivery. It sounds like a logistical ballet, honestly.
It is, and their focus is incredibly sharp. Over 98% of their money comes straight from those core LTL fees, based on weight, distance, how fast you need it there. They run this huge network, 261 service centers nationwide, covering standard domestic LTL, but also expedited services if you need guaranteed delivery times.
Okay, market position. They're the second biggest LTL player by revenue. What was it, $5.81 billion in 2024?
That's the figure. But here's the key. Ask anyone in the industry, and they'll likely tell you ODFL is #1 for quality.
And there's hard proof for that claim, right?
Oh, yeah. The numbers are pretty stunning. A 99% on-time delivery rate. Think about that complexity we just described. Hitting 99% is incredible, and their cargo claims ratio, just 0.1%. Practically nothing gets lost or damaged.
That quality has to be the bedrock of their advantage.
It absolutely is, and it flows directly to efficiency. Their operating ratio, basically cost as a percentage of revenue, is consistently 1,500 basis points better than the industry average.
15 percentage points. In trucking, that's massive.
It's a huge permanent cost advantage built right into their model, year in, year out.
Okay, but you mentioned something before we started. Their capacity strategy. That sounds counterintuitive. They keep capacity empty.
Yes. And this is where you see the strategic genius, I think. They deliberately maintain 25% to 30% excess capacity in their network. Doors, trucks, people, ready to go.
That sounds inefficient. Why pay for resources you're not using most of the time?
Because they're playing chess while others might be playing checkers. When there's a sudden surge in demand, think about when Yellow Corporation collapsed back in 2023, competitors are scrambling, service suffered, ODFL, they just opened the taps on that spare capacity. They could aggressively absorb all that new business without letting their service quality slip even a little. They gain share, and the quality gap widens. It's brilliant during disruptions.
Right, and the overall LTL market is growing, about $114 billion.
Yeah, growing steadily. Things like e-commerce, more complex supply chains, and this trend of nearshoring or reshoring manufacturing, bringing it closer to home, all that fuels LTL demand.
It's also pretty consolidated. The top 10 players have most of the market, and there's that change coming with pricing based on density, not just class.
Exactly. The NMFTA overhaul, that shift likely favors the bigger, more sophisticated players like ODFL, who have the tech and systems to handle density-based rating accurately.
Okay, so a complex, quality-driven operation. Who's running the show? Let's talk leadership.
Good transition. Chapter 2, Management Evaluation. The word that comes to mind here is stability. The CEO, Marty Freeman, he joined ODFL way back in 1992, rose through the ranks.
It's a long tenure.
Very. It's typical there. They promote from within, people stay. Compare that to some competitors where you see a lot more executive turnover. This fosters a real long-term perspective. They're not just managing quarter to quarter.
And how do they handle the company's money? Capital allocation.
Priority number 1 is reinvesting right back into that core network. That's their engine. For 2025, they've budgeted $450 million for capital expenditures.
Where is that going?
Mostly real estate expanding service centers, about $210 million. And then $190 million for the fleet, keeping trucks and trailers modern and efficient. And notice, it's all organic growth. They strongly prefer building it themselves over buying competitors through big M&A deals. It protects the quality and integration of the network.
Makes sense. What about returning cash to shareholders?
After they funded the network needs, yes, they return capital consistently. Share buybacks are significant, what was it, $424.6 million just in the first half of 2025.
Wow.
And they pay a growing dividend. It's very safe, too. The payout ratio is low, around 21%, so plenty of cushion there.
Okay, but let's get quantitative. You mentioned a key metric that really shows management effectiveness, the ROIC.
Right, return on invested capital. This is crucial. ODFL's ROIC is an exceptional 25.0%.
25%. Just saying the number. Okay, break that down. What does that really tell us compared to their peers?
It tells you they are incredibly good at generating profit from the money they invest back into the business. For every dollar they deploy buying terminals, trucks, they generate about 25 cents in profit from that investment. And context is key here. That 25% is more than double what XPO manages. And it's more than triple FedEx Freight's ROIC.
Okay, so it's not just talk about quality. It translates directly into superior financial returns on their investment.
Precisely. It proves the economic value of their strategy.
Which leads us perfectly into the overall financial picture.
Let's look at it. Chapter 3, Financial Analysis.
So that quality and efficiency must show up in the margins, right?
Absolutely. Look at their operating profit margin over the last 12 months, TTM. It's 25.39%.
For a trucking company with all those assets and fuel costs, that's really high.
It's exceptional, especially in a capital-intensive industry. That margin strength is rare.
And does that mean they generate a lot of cash, free cash flow?
Tons of it. Even with the recent downturn, their free cash flow, FCF, has been remarkably steady, consistently near $900 million a year. Hit $908 million in 2024, smack in the middle of the freight recession. That cash generation fuels their ability to reinvest and also drives impressive long-term earnings growth. Their earnings per share, EPS, has compounded at an average of 18.3% annually over the past decade.
Okay, strong margins, strong cash flow. But you mentioned something earlier that sounded critical, the balance sheet.
Yes. This might be the single most important financial point. The balance sheet is, well, a fortress.
Define fortress in numbers.
Their debt-to-equity ratio, it's just 0.04.
0.04, so 4% debt relative to equity. That's practically nothing.
It's negligible.
Yeah.
Minimal debt. Now think about why that's so powerful, especially during a recession.
Okay, if your competitors are loaded with debt when times get tough.
They have to pull back. They have to conserve cash to service that debt. They cut capital spending, maybe lay off drivers, service quality drops.
With ODFL, with almost no debt.
Faces none of that pressure. They have immense financial flexibility. They can keep investing like that $450 million CapEx budget this year while competitors are forced into retreat. That balance sheet isn't just safe. It's a competitive weapon. It lets them gain share because of the downturn.
Wow. Okay. So financially incredibly strong. Let's quickly touch on valuation before we look at market view. The PE ratio is high-ish, 27.5.
It is. Trades at a premium, but that's actually right in line with its 10-year average PE. The market has historically awarded it a premium for its quality and growth.
And you mentioned a DCF model, discounted cash flow. Just remind us what that tries to do.
Sure. It's a way to estimate intrinsic value by projecting out a company's future free cash flows and then discounting them back to what they're worth today. It's based on the idea that a business is worth the sum of the cash it can generate over its lifetime.
And using conservative assumptions, you mentioned an 8.5% discount rate, 3% long-term growth.
Yeah.
Where did that DCF calculation land for ODFL's value?
Our educational model puts the estimated intrinsic value in a range between $155 DZI and $175 per share.
Okay, $155 to $175. Keep that range in mind. Now, let's see how the broader market feels about ODFL right now.
All right. Chapter 4, Market Sentiment.
What's the Wall Street consensus? Buy, sell, hold.
It's leaning cautious. The average rating is a hold, and that definitely reflects the uncertainty hanging over the whole freight market right now.
Any price targets?
The average target is around $162, but the range is huge, from $129 all the way up to $195.
That wide range tells you something, doesn't it?
It tells you analysts are really divided or maybe just unsure about how quickly things will recover. Predicting the timing and depth of this cycle is tough.
And what's the general tone in news reports or commentary?
Pretty factual, also cautious, reflecting what management themselves are saying, acknowledging that ongoing softness in the domestic economy. Lots of reports focus on the year-over-year declines in tonnage. It's reflecting the current reality.
Are there technical indicators supporting that caution? Moving averages.
Yes, the technical picture is negative short-term. The stock is trading well below both its 50-day moving average, which is around $153, and its 200-day average, near $169. That confirms the recent downward pressure.
And are people actively betting against the stock? Short interest.
There's a meaningful amount of short interest, yeah, somewhere between 5.5% and 6.3% of the available shares are shorted. So a non-trivial number of market participants are betting the price will go down further in the near term.
So even with all that quality we discussed, the market is clearly focused on the immediate economic headwinds. That premium PE makes it vulnerable if the recovery takes longer than hoped.
That's the tension, exactly. You're paying a premium price, reflecting that long-term quality and expected outperformance. But in the short term, it's still a cyclical business tied to the economy. If the downturn drags on, that multiple could definitely face more pressure.
Okay, who actually owns these shares? Let's look at the holders.
Sure thing. Chapter 5, Ownership Structure. Well, first off, institutions love this stock. Big funds, pension plans, etc. They own a huge chunk, somewhere between 77% and 86% of the company.
What does that tell you?
It confirms its status as a sort of blue chip quality name. The big players, the Vanguards, BlackRocks, T. Rowe Prices of the world, they hold significant positions. They see it as a core holding.
What about insiders? Management, founders?
Very significant insider ownership, too, especially the founding Congdon family. Estimates vary, but they likely hold between 4.6% and maybe up to 11.8%.
That's real skin in the game.
Exactly. When founders and management own that much, their interests are strongly aligned with long-term shareholders. They're focused on building value over decades, not just hitting next quarter's numbers.
So lots of big institutions, strong insider alignment. Is ownership concentrated?
Highly. The top 15 shareholders, combining those big institutions and the family holdings, own over half the company.
Interesting. Okay, let's pivot to the potential downsides. Every investment has risks.
Absolutely crucial to cover. Chapter 6, Risk Assessment.
Maybe start by quickly recapping the strengths that act as risk mitigators. The moat.
Right. The core defenses are that superior service quality others struggle to match, the incredible efficiency shown by that 25% ROIC, and, of course, the fortress balance sheet with negligible debt, that 0.04 DE ratio. Those reduce internal risk significantly.
But the big threats are external, right? The environment they operate in.
Almost entirely. The number one risk is simply the cyclical nature of the U.S. economy. ODFL is deeply tied to domestic economic activity. A prolonged or deeper than expected recession is the biggest threat.
And related to that, interest rates.
Yes, higher interest rates slow the economy down, which directly reduces demand for trucking and freight services. It's a direct hit to their top line.
Plus inflation. Fuel, labor, equipment costs.
All of that puts pressure on margins, even for an efficient operator like ODFL. Persistent inflation is a definite headwind.
And you mentioned something specific earlier, the 2025 U.S. tariffs. How does that play in?
That adds a layer of geopolitical risk and uncertainty. Tariffs can disrupt trade flows, potentially reducing the volume of imported goods that need LTL transport within the U.S. It could also cause unpredictable shifts in supply chains, further muddying the demand picture. It's a wild card.
Okay, those are the threats. But what about the upside potential, the opportunities?
Well, the flip side of the cyclical risk is cyclical recovery. Plus, those long-term structural trends are still very much in play. E-commerce keeps growing, nearshoring, shoring. It continues to reshape supply chains in ways that benefit domestic LTL. And critically, ODFL is poised to keep taking market share. Every time there's a disruption or downturn, they leverage their strengths, service, capacity, balance sheet to grab more business from weaker competitors. That's a powerful ongoing opportunity.
All right, let's try and pull all these threads together. Time for the wrap-up.
Okay. Chapter 7, Conclusion.
So, summing up the positive case, the bull argument for ODFL, what is it in a nutshell?
It's simply the undisputed quality leader in its space. They have the service advantage, which gives them pricing power. They have unmatched operational efficiency. They have that strategic capacity buffer. And crucially, they have the financial strength, that near zero debt, to not just survive downturns, but actually benefit from them by taking share. It's a classic compounding machine.
Okay. Now, the other side, the bear case. Why might someone be cautious or negative right now?
It boils down to the cycle. Simple as that. The company, despite its strengths, is caught in a significant freight recession. That's being made worse by high interest rates and now this added uncertainty from trade tariffs. This could mean the current softness in revenue lasts longer than expected, keeping pressure on the stock price, especially given its premium valuation. The negative technicals and the short interest reflect this near-term cyclical pain.
And let's revisit that valuation point one last time. Our DCF model suggested intrinsic value between $155 and $175 per share. Where's the stock trading again?
Around $141.79 as of our data point, so currently trading below the low end of that calculated range.
Interesting. So the market seems to be heavily weighting the short-term cyclical headwinds.
It appears so. The market is punishing ODFL for the macroeconomic environment, perhaps more than the company's long-term strengths would warrant. For an investor focused on years, not months, that gap between the current price and our estimate of intrinsic value suggests there could be a margin of safety, buying a truly high-quality business potentially on sale due to temporary factors.
Okay, a final thought then, something for you, the listener, to chew on. ODFL has built its entire decades-long success on demanding a premium price for superior reliability. Customers consistently pay it, even when money's tight. So what does that unwavering customer willingness to pay for reliability tell us about the hidden costs, the brittleness maybe, that's lurking in so many other parts of American supply chains? The risks people ignore until something breaks.
That's a great question to ponder. And if you found this deep dive valuable, please do consider liking and subscribing to Stock Analytics AI. Remember, our members paying €4.99 a month get priority access to deep dives like this one. We're planning to cover all the S&P 500 stocks over the coming months, and members get first dibs on which tickers we analyze. And hey, if you just want a one-off analysis of a specific stock, drop us a super thanks. We appreciate the support.
And just the standard reminder, this analysis was generated by an AI system. It's for educational purposes only. It is definitely not financial advice. Please always do your own research or talk to a qualified financial advisor before making any investment decisions. Excellent discussion. Really highlights the difference quality makes. We'll catch you on the next deep dive.